Should you be buying in the burbs or not? And how do you decide what suburb to actually acquire in or invest in? Hi, I'm Jaryd Krause. I'm the co-host of the Property Pals Australia podcast.
And I'm Sam Powell, and in this episode, we talk about more short-term data and what are the top 5 things to look at for, picking your suburb. There's a macro approach, and then going into a bit more of a micro, and there's a few key things like vacancy rates, affordability. We touched on a few really key points that I think everyone should definitely consider when they're making their decisions. And obviously, there's more juice behind the episode and the podcast if you want to go deeper into. So hope you enjoy it.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Samuel, another episode. Let's get into it.
Doubling down. The last episode, if you didn't catch it, we talked about, more of the macro sort of effects of how to pick a good region to target for investment. And in this one, we're going to jump into more of the micro. So looking at, the short-term suburb trends and data points and key things to look at. And Jaryd's helped me to top 5. That's right, mate?
Yeah, that's right. Make sure, I know there's a bunch of different things that you can find out about, and consider when you've found your location and you want the right sort of suburb. You want the right place in that location in terms of suburb and whatnot. But guys, listen to episode number 90. I think it's the last one, number 96, because this is how to choose a location first before you move on to this one. If you haven't listened already. So I want to try and distill it down to, once you've found the location, Sam, what are some of the things that you should be looking for in terms of a suburb? And then what about within a suburb? Say you tell me to go, in a certain area, I'm like, okay, cool. Now what do I look for? what are the top 5? If you had to cull some, what would you distill it down to?
Well, I'll start up with number 1, which I always like to look at because it's supply and demand. So in order to outperform, you want obviously supply decreasing and demand increasing. So a way to see that supply level is the days on market, and not just the number, but the trend as well. So you think about if the days on market to sell a property is above 60, that's 2 months. So it probably goes on the market, it sits there for 2 months. That's not a lot, not a lot of demand, so to speak. So there's areas, in Adelaide that it's 10 days on market. So it's quite strong.
Quite fast. Strong. Yeah.
And then,
sorry, go on.
I'd say it's not just the number though, because you could get 30 days on market and go, oh, that's strong. It's under 60, it's really good, but it could have been going up from 10 days on market to 20 days on market to now 30 days on market over the last 2 months. So the trend is actually going away from you. So that's one of the key ones I look at.
Something to consider for sure, days on market. And how do you work out if the trend is coming towards you or going away from you or staying the same in terms of days on market?
That's a good question, mate. You got to pay to play.
You need the data. You need to pay for hashtag analytics and things like that, right?
Yeah, and they're pretty cheap. Cheap in maybe a couple $100 a month.
Which is cheap compared to investing a couple $100,000.
Exactly, mate. Exactly.
Well, it's funny with people penny pitching to buy a property. You're spending hundreds of thousands of dollars, mate. Just if you're trying to save money by buying it yourself, spend a little bit at least to give you the right resources in terms of data.
Yeah, exactly. And the other one,
second big one,
second big one's affordability. It's a pretty big one, really. And why I say that for investing is people flock to areas that they can afford. There's always a great Australian dream, and it's becoming more and more out of reach. We talk about, the medium class erosion going through, or middle class, not medium, middle class erosion going through at the moment. And basically, it's harder and harder for people to save for a deposit and then buy a property. Everyone understands the value of getting into the property market for wealth, but when you actually go and do that, a lot of people struggle to buy property in locations they want to live. So they're sort of seeking out, well, where's the best location for my budget? And that's why looking at affordability metrics is key. So places where, it takes over 50 years to, like, the affordability is based on what's the typical house price against the typical income for that household in that area. And you extrapolate it out going, well, with that household income, you typically pay off your loan if you were to buy a typical house in this region for X number of years. Does that make sense?
Yeah. So you're looking at how much people are being paid, right? What's their wage, and then how long it would take them to pay off that certain house. And then what's the metric? Do you want the least amount of time to pay off the house or max amount of time, and why?
Well, the typical loan period is 30 years, right? So you're trying to find something where under 30 years is good. Most of those locations along there, they might not be the most desirable locations in Australia for people to live, because most places that are within, say, 200 k's of a major CBD, they probably sit around that 30 to 50 range. Probably going to Sydney, there's some places like in the eastern suburbs it's 80 years to pay back. But like you sit there and go, well, how's that even possible? Well, it's because you've got high income earners in there, and they don't use full debt to buy their properties. So it's a different kettle of fish. But I like to target things below 45 generally, and the lower the better. But that leans into the next key metric, which is for me, which is the social and like social demographics of the area. So both these are once again paid membership.
Paid data. You need to be paid to get that data. Yeah, I was going to ask you, how do you work out like what's the income of that area, and then the time on time it takes to. You could try and use ChatGPT, but
you can try
to be as accurate as
Well, the ABS, Australian Bureau of Statistics, will give that for you. So you don't have to pay for it, but what's your time worth?
Exactly.
You probably chuck it all in ChatGPT, but then you got to go find that specific area. Like, it's not for me. So I just pay for the data.
So that's two big ones. Okay. Yeah.
Yeah, and then the third one was the social and economic ranking for the area. So would they rank? It's like the IRSAD, indicator of relative social and economic disadvantage, and they range from 1 to 10, 1 being not good, 10 being highly affluent. So the reason why I look at that is because it's you can find locations, but as an investor, you do want you want low tenant turnover rate, because that obviously
people that can afford the rent, and then
the rent and the tenant type as well. Like that's where property investing sucks. When you got high tenant turnover, you're paying every year, a week and a half worth of rent to find a new tenant, property manager. Vacancy rates, or at worst, you get tenants that are just drop kicks.
And they don't treat, it's unfortunate to say, but people that have a bit more affluence are typically a little bit more orderly, and there's typically less damage to a property.
Yeah, pride of place.
The trend here really is there's more money in that area or coming into that area, right? So the top three so far is days on market, and then you've got their wage versus how long it takes to pay off that property, and then you've got like the demographics in terms of like the more affluent the better, but you still need to play that game of like don't want to be too affluent, so there's like there is decent growth from like what we talked about in our last episode, the rags to riches story, and how that works as well. So there's a happy medium with all of these. So that's three. Can you just stick to two more, or like how tough is that going to be for you?
Well, I mean, I'm just going off like sort of my filtering process, and to go even deeper, there's like we've done the sort of the bigger macro picture prior to this episode, and now we're doing a bit more micro. When it comes to the micro, there's 100 different data points that I look at. You know, it's time consuming, but there's never like these ones have a bit more higher weighting in my opinion. So like with the socioeconomic factors, there's clear data where like you can, if you're in that lower price point, sub 500, you know, a score of 1 is the lowest you can get, but you know you can double house prices with a score of 1. Typically, probably the more lower, like say 300, 400, to double to 800 within sort of a 10-year period is possible, but it's a real challenge to get it to keep doubling if it doesn't have a higher socioeconomic ranking. So I tend to be looking at 2 plus for that reason.
Where are you getting this number?
It's once again paid data, so it's like a ranking system based on public housing and I guess like socioeconomic factors like education, income, public housing, crime rates, things like that, all combined into one. Once again, they're paid data sources.
Where would you get this paid data source?
You can go to HAG Analytics, DSI Data. You can even go into places like Suburbs Finder that have those types of data points to look at. Great. And microburbs as well.
Cool. Awesome. All right. So clearly something that's, in that 500-ish K range, but, ticks those other boxes as well. Have you got one more that you can?
Oh, I got 2.
You got 2. All right. We'll let you be greedy. We'll give you 6.
No, that's 5. I did 3. Then you got to go on 5. Come on.
No, the 4th one was the rating 1 or 2.
Oh no, that's the socioeconomic one, number 3.
Oh, okay. Well, so we're still on number 3.
Sorry.
Yeah, no, that's fine. What's number 4?
I like to look at vacancy rates for just like if you go and buy a property, you don't want to buy it and then put it on the market to rent it for it to sit there for 4 weeks with no income because that's 500 to 700 and odd bucks that you just sort of you're paying the repayments on, and also from a growth perspective too, the places that basically are the vacancy rate is getting tighter, rents are increasing, so that's a positive sign for growth. And then when rents increase to a point where renters are like, well, I may as well go and buy because of how much I'm paying in rent, they become property buyers, and that also adds to the growth of the location on the back end. As investors, we want to get in before the owner-occupiers sort of get it in a bit of a flurry. And over the years, that's sort of like a key thing that I like to look at. And from a vacancy rate number perspective, below 3% is always the goal. However, given the Australian environment at the moment, it's dropped. 2% or below is probably more is a stronger metric now. And then once similar to the days on market, like you got to be looking at the trend as well. If the trend's going up, then obviously you sort of you've got to factor that into your, I guess, overall assessment.
It's a really good point with the housing crisis and the demand for rent in areas. You can have places with a low vacancy rate, but you want even lower. Like compare to other, you need to compare to others. You don't just want to take a general term because it depends on where the market's at.
Yeah, like in WA at the moment, places I was buying a number of years ago, there's that suck out of supply with the houses, and the vacancy rates they were like below 1%. Now they're sitting around 2%, but they're trending up. So rents are like the growth rates stopped, and there's some parts that are declining because there's more stock on market now. So something to think about. Number
5.
Number 5, I just look at this is the supply metric. So like, what's the number of building approvals that are coming in to the area? So like you can have all the key data metrics and everything looks great, but if you're not looking at, well, what's the supply that's coming to that suburb? There could be 1,000 lot subdivision or 10,000 units coming into that area in the next couple of years, and there's that's going to really, like, you'll get the short-term growth, but then you're going to have a sort of flat medium period after that. And you shouldn't just be investing for a few years. It should be, in my eyes, 4 at a minimum, and going in to try and holding it for 30 years if you can.
Yeah, I would say as a general rule, like if you're doing it yourself and it's your first time investment, like look at holding it for a lot longer. But if you've got somebody that's pretty skilled and a buyer's agent that can get you growth in the first few years because they're just so good at pinpointing these locations, suburbs and areas, then you could decrease the amount of time you're holding the property. Very general, like bit of advice, and that's obviously not financial advice. But
as always, it's all general in nature, and it's just not financial advice. But I thought I'd keep this one nice and short and sweet. Get straight to the point.
Yeah, it doesn't need to be long. So thanks, Sam. 5 of those, absolutely awesome. And yeah, we've got some more good stuff coming to you guys. So stay tuned.